All right, let's talk about SouthState Corporation. They just dropped their Q2 earnings, and honestly, it was a powerhouse quarter. But the market's reaction was, well, a little sleepy. So today, we're going to dig into that story because there's a really interesting disconnect happening here.
So here's the game plan. We'll start with those blockbuster results. Then we'll unpack the growth engine that's making it all happen. We'll look at how they're mastering their margins, what management sees coming down the pike, and finally, we'll give you our take on the stock.
Okay, so let's just get right into it. To put it simply, SouthState absolutely knocked it out of the park this quarter. I mean, they beat expectations on pretty much every important metric. It's proof that the big strategic moves they've been making are really paying off. And here's the headline number that got everyone's attention. Adjusted earnings per share of $2.30. Now, Wall Street was looking for something closer to $2.02. So this wasn't just a small beat, This was a nearly 14% beat. That's a huge statement about this company's earnings power. And that leads us to the big puzzle here. You have these incredible results, you've got a management team sounding super confident on their call, and the stock, it barely budged. So what is going on? What is the market missing that these fundamentals are practically screaming from the rooftops? Well, a big part of the answer starts with their massive acquisition of Independent Bank. You'll see it as IBTX. Now, this wasn't just a deal to get bigger. This was a total game changer to get better. It was a strategic masterstroke that put them right in the middle of some of the fastest growing markets in the entire country. So, the deal officially closed back in early 2024. By the first quarter of this year, you could already see things starting to accelerate. But Q2 was the real test. They had to complete this really complex computer system conversion, and they nailed it. That means the messy integration work is officially in the rearview mirror. And bam, you can see the impact right here. With all that integration work done, it's like they just flipped a switch on the lending engine. Loan originations skyrocketed by 57% from just last quarter. We're talking going from $2 billion to over $3 billion. That's pure, tangible growth. And you don't have to take my word for it. The CEO, John Corbett, said it himself. This whole deal was a very deliberate move into the high-octane markets in Texas and Colorado. They are exactly where they plan to be, and now they have the size and the platform to really compete. So the growth is obviously there. But is it profitable growth? That's always the key question, right? Well, let's pop the hood and look at their profitability, because the story here is just as impressive. They are absolutely mastering the spread between what they earn and what they pay. Check this out. This is like banking 101, but just executed to perfection. The interest they earn on their loans went up. At the same time, the interest they have to pay out on their deposits actually went down. I mean, earning more while paying less, that is the absolute dream scenario for a bank. And all of that beautiful discipline led to a net interest margin, or NIM, of 4.02%. Now, why is that so significant? Because management's own guidance for this quarter topped out at 3.90%. So they didn't just meet expectations, they smashed right through the ceiling of their own forecast. That shows incredible control. And the rest of the report card looks just as good. The return on tangible common equity, a really key profitability metric, was almost 20%. That's considered elite territory. Their efficiency ratio came in under 50%, which means they're super disciplined on costs. And they're sharing the success with investors, an 11% dividend hike and great growth in book value. Okay, so the quarter that just passed was fantastic. But what about the future? Can they keep this momentum going? Well, if you listen to what management had to say, their outlook isn't just confident, it's backed up by some seriously powerful numbers. For me, the biggest takeaway from their guidance is the loan pipeline. Just look at this. It grew a massive 45% in Q1, and then it grew another 31% in Q2. That is just explosive forward momentum. On top of that, they're guiding for their margins to stay strong, they're focused on returning capital to shareholders, and they're making it really clear the focus now is on organic growth, not more big deals. All right, so let's put all the pieces together. We have a monster quarter, a merger integration that went off without a hitch, and a really bullish outlook from the people running the show. So, how do we square all of that with the market just kind of shrugging its shoulders? Look, the bull case here is crystal clear. The execution was flawless, the numbers are fantastic, and the guidance is strong. The market's quiet reaction tells me it's still in a wait-and-see mode, maybe not giving them full credit yet for pulling off such a big transformation.
And that disconnect, that gap between fundamental reality and market perception, that's often where you find opportunity.
And for exactly that reason, our rating on SouthState is outperform. Bottom line, this is a more powerful, more profitable, and just a flat-out better bank than it was a year ago. We believe the market just hasn't caught up to the new reality of this company's earnings power and growth path. So, that's our analysis of SouthState's very impressive quarter. Of course, remember to always do your own research. This is not financial advice.